Hello folks, this is Atlas Capital, Etoro Popular Investor, and today we are going to discuss dollar cost averaging approach, its benefits and disadvantages. Every now and then you can hear how beneficial this approach is from a different people, different investors promoting this approach, but I would like to show you that this approach brings some disadvantages in a particular situation, which we are going to look into. Now, before we start, I would like to share with you my Etoro page, and I encourage you to look into this. If you don't have Etoro account, it's very straightforward to set up one. And if you have any questions in setting up this account, you can leave in comment sections below. So here you will see an overview of my strategy and my approach, and some instructions to my copiers. There are also stats page. Since the beginning of portfolio history, I am doing performance review on a monthly basis, and I will usually post it here on my feed. And so it's quite straightforward, and it's very easy to use. And eToro actually is a unique platform nowadays because it allows people to replicate portfolios of different investors, including myself. Okay, so now we're going to see how how dollar cost averaging, which results it can bring to an investor in two hypothetical scenarios. But first we will look into definition of dollar cost averaging, and as you can see from a definition, that's when you spread your investment during some period. Again, the period is not mentioned here, so it can be 1 year, 2 years, 3 years, whatever period. So we are going to see scenarios with 4 years of investment. So if you are thinking about using dollar cost averaging, first of all you need to determine your investment objectives, because it usually depends on your investment objectives, how successful you are going to be with dollar cost averaging. And in turn it requires you to consider some factors such as time period, your financial goals, and these two are usually quite straightforward, because the one will know usually how long they are going to invest and at what age they are. Now, second one is also more or less straightforward to understand. What do you want to achieve in the end? The third one is not so straightforward, and the one of the tools you can use to understand this is to fill in a risk tolerance questionnaire. I'm going to leave link into description to one of the questionnaires which you can use. And here is a typical question you will have in this questionnaire. So try to answer this question, and if you answer this, then dollar cost averaging most likely will not be appropriate for you. And this one I believe as well. So it's more about these two type of investors, which I believe will be eventually happy with applying dollar cost averaging approach. When I just started my investing career, I would have allocated myself into this category, and that's because I believe that when you are just starting, you can have a little bit more risk tolerance. For me personally, it's not a big difference. Either I have 1,000 or US dollars, or I have 500 US dollars. But what make me feel happy if I have an opportunity to grow my 1,000 to 2,000, for example. But with the age and as one mature as an investor, I believe the risk tolerance will usually will adjust as well. So me personally, I am now somewhere in this category, more or less, I believe. But it's actually, it depends. It depends on market valuation as well, because my portfolio is managed. I manage my portfolio on a dynamic basis, and when markets go down and drop significantly, I will usually increase my stocks exposure. So I will become more of a high risk tolerance investor if market conditions allow. And when markets are on a high end, on a peak level, I usually go into this category by selling part of my stocks and keeping more spare cash. So a dollar cost averaging program is not something I usually apply in my portfolio management for these reasons. Now I have built two scenarios, and this is actually a very important statement, very important observation. Results of your DCA program will be determined by future market behavior during your investing period. And I'm going to show you what does it mean, but this is very important statement. So first scenario, we will look into when DCA will be beneficial, and we will build a hypothetical in portfolio with a S&P 500 as an investment. So in first case, we are going to invest 17,000 into from the beginning without any subsequent contributions. And the second portfolio, this I call it with dollar cost averaging approach. We will contribute 1,000 on a quarterly basis, and initial amount will be 1,000. So during 4 years, it will give us the same 17,000. Now we are going to see how these two portfolios behave during period examined. So first portfolio, which was without DCA, decreased to 13,000 from 17, so we actually lost money here. And the second portfolio has grown by 500 US dollars, meaning that at least we didn't lose anything and we earn a little bit. And that's the difference between the two approaches. Is around 4,000 or 13%. So as we can see from this chart, the portfolio, when we applied dollar cost averaging, delivered us better results, but that's because S&P 500 overall didn't perform well during this period from 2000 until 2003. Okay, so Now we will have a look into second example, when DCA was actually destructive to our portfolio. That's for the period from 2010 until 2013. And again, we invest in S&P 500, 17,000 at the beginning of 2010, and 1,000, and for the second scenario it's 1,000 quarterly, and initial amount just 1,000. We can see in this scenario that a program without DCA, a portfolio without DCA actually delivered us better result. This difference was 5,700 or 19%. Now don't overestimate this, because over time, if you keep investing, this 5,700 eventually can grow to a very decent amount of money over long term. So we can see that during this period, portfolio without DCA actually delivered better result, because S&P 500 itself during this period was constantly growing. Okay guys, thank you for watching this video, and I hope you found this useful, and I encourage you to check once again my eToro page and my website as well, where you can find useful information about myself, and if you have any questions, feel free to reach out.